Hello and welcome to Edison TV. Now, as we all know, there is gold and there are gold equities, and the idea is that the equities should outperform the metal. The reality, of course, is that the equities don't always, and for any of you in the sector who are invested, you'll know that to your cost. However, today we're very pleased to have an exception to that rule, which is Wheaton Precious Metals, and I would like to introduce their President and CEO, Randy Smallwood. Randy, very good afternoon to you. Thank you very much indeed for joining us.
A true pleasure. Thank you.
You've outperformed the gold price now by my calculation about 30%. This is your share price, excluding dividends, by about 30% since 2010. You must be delighted. Tell us a little bit about the business model.
Well, I think the results speak to the strength of the business model. Our business model is one that takes a lot of risk out of a traditional mining investment, yet we still deliver all the positives of a good mining investment in terms of exploration upside, expansion capital, and mainly a leveraged exposure to the commodity price itself. And so when you add all those up, and the fact that we've taken the cost risk out of a traditional mining investment, the math is simple. We should outperform gold, and we have. So I think it just speaks to the strength of the business model.
Which is excellent news. Just for those out there who don't understand streaming, could you just explain it?
Sure. Okay. So we're close to 30 some odd billion U.S. market cap company that has 40 employees. I think we have 41 employees right now, actually. Very, very small, and from a G&A perspective, mainly because we don't operate mines, but we selectively invest into mines. And we do that through what's called a streaming contract. A streaming contract is a contract between the operator and ourselves where we get a portion of the metal at a fixed cost. And we buy that streaming contract with our capital commitment, which is our upfront contribution. A lot of times that capital is used to help build the mine or help expand the mine, or sometimes to improve the company's, the operating company's balance sheet. Sometimes debt is a bit of an issue and they have to manage that. But a lot of times what we will do is we'll approach, in fact, more than 60% of our precious metals production comes from copper mines. And so we approach the copper mining companies because just about every copper mine in the world produces a little bit of gold. Not a lot of gold, they're mainly copper mines. But what we do is go in and buy that non-core byproduct gold production from these copper mines on a go-forward basis. And so it just allows us to invest into some of the best mines in the world, most profitable mines in the world, most of them of which are supplying critical minerals to the world itself. But we get the non-core byproduct precious metals, both gold and some silver, and we then present that to our shareholders. And so this year we're going to produce about 600,000 ounces of gold equivalent production, pretty close to 600,000 ounces. And we've got incredible growth over the next 5-6 years where we're going to see getting close to 1 million gold equivalent ounces at a beautiful low fixed cost of about $440 per ounce. It's an amazing business model.
So you're putting capital up front, and then you're effectively buying the gold for $440 an ounce.
Right.
And then when they deliver it to you as a byproduct, which is usually, as far as their shareholders are concerned, quite often forgotten about.
Right.
And then you can sell that gold at $2,600 or whatever the prevailing price is at the time. So you're making $2,000 an ounce on $100,000 a year.
Even more.
So whatever the figure is.
Exactly.
And of course, the amount you pay up front, which also helps them to develop the mine. And that is part of your investment scenario and how you assess streams and the value of a stream. Could you just go into that briefly, how you look? You're putting the capital up front, you're then paying a low price, you're getting the high gold price, but, what sort of returns are you looking for?
So about half of our company is technical. I'm a geological engineer by background, myself, and we have metallurgists and geologists and mining engineers and social scientists that are focused on helping us, firstly, invest into good mines, but secondly, avoid the bad mines, stay away from the bad operations. And we go in and do a very thorough due diligence process, all the way back to first principles, take the assay data, build up our own block model, build up our own mine plan. We can grind that through in a couple of weeks where we can come up with our own vision of how this mine should be operated. We then compare it to the operator's forecasts, and rarely are they the same. And so we need to understand why there's differences. What is the difference approach? Sometimes we unlock some value because it's a fresh set of eyes that has looked at the same data, but isn't biased by any predispositions or anything like that going forward. But the first thing we're testing, of course, is that this is a profitable mine for our partners. Because if our partners aren't profitable, we won't be. So it's one of the reasons that we really put a lot of focus on the operating margins of the mine. We want to make sure that they are the best or the highest margin mines in the world. 93% of our production comes from the first and second quartile, so the bottom half of the respective cost curve. That's when you sit and think about 18 mines delivering us metal this year. Next year, we have 4 new mines coming on stream. We have the 22 mines, and the fact that we have such a high portion of that production coming in the bottom half, I don't think there's another mining company in the world that has that level of quality. But we dive through, and then, once we get that mine plan, we have to assess risk. How do we bring that back to a value today? And that's where it's the calculation of the discount rate that's just incredibly detailed for us. We put a lot of effort into trying to capture political risk, partner risk, geological risk, metallurgical risk, community risk, jurisdictional, all of that all feeds into what kind of a return do we need off of these mines. And so that allows us to sort of broaden our horizons in terms of where. Now, most of our assets are in the Americas, mainly because we spent the first 10 years focused on silver. And that's where most silver comes from. But back about 10 years ago, we started really focusing on the gold side, and we're now more of a gold company than silver. We still are very healthy. About 30 to 35% of our revenue comes from silver, so still one of the biggest silver plays in the space. But we are dominated by gold now, and we measure through and look at these projects and determine the value through trying to capture those risks on a go-forward basis. And I think we've done a pretty good job so far.
I don't think anyone could deny that. And the idea is it should be a win-win both for you and the company. So it's not a robbing Peter to pay Paul scenario. Your earnings that you get from their byproduct are worth much more to you than they are to the company themselves, almost certainly.
It's one of the most important aspects of being successful in this business is that they need to be win-win relationships because they're life of mine relationships. Our relationships go for as long as that mine runs, and so we need it to be positive. On top of that, it's very important when it comes to developing new opportunities and new growth. The reason we have such a strong growth profile in the industry, the strongest in the entire precious metal space, is because we've got a lot of previous partners. We've got a lot of repeat customers, I think is the way to describe it. Out of the last 10 transactions that we've done, 7 of them are with people or companies that we have worked with in the past. 5 of them were non-competitive. That's the best type of repeat customer, someone that comes back to us looking for capital, and they have so much faith in our ability to be fair that they won't even run through a competitive process, and they'll assess whether a proposal is fair or not and then go forward. So to be able to get to that point of being a partner of choice is really, I think, what differentiates Wheaton, and we've had great success at that, making sure that people want to work with us.
And I mean, we should just say, you say your partners. I mean, there are some fantastic names there, aren't there? I mean, there's Vale's, there are Glencore's, there are, These are the top draw stuff when it comes from the mining industry.
The streaming industry, we're blessed with an industry that always needs capital, and different segments of it need capital at different times. And so, yes, we've got partners from Newmont to Barrick to Vale to Glencore, all the way down to single asset companies like our most recent transaction, Montage Gold out of with Côte d'Ivoire, the Kone project, single asset development company moving forward. Streaming works for the entire mining industry.
Now, so you're providing funding to the mining industry.
Oh, yeah.
Is one way of looking at part of what we do. To what extent are you benefiting from the fact that, if you like, the equity markets and the debt markets aren't really working for the mining industry?
It's an incredible advantage. It's where most of our opportunity comes from right now, is that the equity markets, most of the companies that we're dealing with have equities that are trading at a discount to net asset value. When we do a stream, we do it based on the value of the metal, not the value of the equity. So it's inherently much more attractive for a company to finance using a stream than to issue shares. Issuing shares means you're diluting your existing shareholders, and as it should be clear, that's who we work for, is our existing shareholders, not our future shareholders, our existing ones. We work for them in the hopes that they become future shareholders, and that's the key thing for a lot of these companies, is that the dilution through equity financing right now is very heavy. It's a very heavy burden. Whereas if you can do a stream is nowhere near as dilutive. We pay pretty close to full net asset value for that metal as we're buying it.
And you've been fantastically successful at it. Did you ever think you should have been a fund manager, a conventional fund manager? Thought never crossed your mind?
My challenge is, and I know it's one that you share too. I'm a geologist at heart, and so I just love being as close as I can I love I wish I could get more dirt underneath my fingernails. I love it when we get out and actually see the projects itself, and so on. So this is. I think it's a perfect blend between the two.
Up close to the gold face, so to speak.
You can smell it.
Now, talking about the growth profile, you hinted at it earlier, but it's worth putting some numbers behind it.
Yep.
You're going to produce 600-odd thousand of gold equivalent ounces this year. I suspect probably a bit more.
Mm-hmm.
And target is 900,000 in 5 years, maybe a little higher.
With the Koné project, with the 2 recent transactions we announced, Koné and we expanded the Phoenix project with Rio 2 down in Chile. That'll add about another 70,000 gold equivalent ounces of production to the original profile. And to be honest, when I drop it in, our previous forecast was about 850. But when I drop it in, we actually by 2031 just get over that 1 million ounce mark, right? So, a lot of it will come down to delivery on projects, but we have about 13 different projects that are feeding our growth profile over the next while. So there's no one single asset that can impact it dramatically. We should have consistent growth. I truly believe we're going to have about 10% growth every year in production for the next 6 years. Just continuing to add and climb towards that. And I'm confident that by 2031, we will see 1 million gold equivalent ounces.
So approximately, I'm talking round numbers here, 2/3, 66% growth over 6 or 7 years, just on production.
Yeah.
And then you've got whatever the gold price is going to give you, or the silver price is going to give you.
Yeah, we've been already starting to put quarterly reports out that talk about record cash flows. Q3 was record cash flows, record revenues. I don't think we're not going to be having to edit that out. We're going to be having that in a lot of quarterly reports over the next 6 years. I would say every quarter is probably going to be slightly better than the quarter next. Next year is going to be particularly exciting because not only do we have organic growth at our brownfields assets, the ones that are already operating, but we have 4 new mines coming into production next year. And so the end of 2025 is going to be incredibly exciting for us. And we're expecting it'll be a really good kickstart in this growth campaign.
Now, speaking of which, as well as having that record quarterly cash flow, you're also sitting on quite a large net cash position. And by my reckoning, you're not going to be dipping into your revolver, your debt facilities anytime soon.
Yeah.
So you're going to be stacking up cash, which you're going to have to deploy somewhere. And obviously some of it will go back into the business.
Our cash flows are well over $1 billion this coming year and will continue to grow with both the production growing and where I think commodity prices are going. And so we do have about $2 billion in commitments over the next 4 to 5 years in terms of helping fund some of these new projects as they come into play, because we usually drip feed that money in during the construction period. And so some of these mines that are coming into production over the next 4 or 5 years will be about $2 billion in total commitments. But with over $1 billion in cash flow per year going forward,
you'll easily cover that.
We'll easily cover that. I think at the end of the third quarter, we had about $700 million cash on hand. I don't like cash. I'd rather be down closer to zero, to be honest. And so the signal that I've been giving is there's only 2 places for our cash to go. Back into the ground on solid, high-quality assets that are accretively priced in the spirit of the day or in the price of the day, the spot price of the day, or back to the shareholders in the dividend. And so, I think a good way of forecasting how much growth we'll have in the dividend, there will be growth every year. We have committed to a progressive dividend policy on a per share basis, the quantum of which will be decided by how much cash we've got on hand. If we start getting a lazy balance sheet of $1 billion or higher on the balance sheet, you can be sure that there's going to be more aggressive growth in the dividend. If we're down closer to zero, it's probably going to be minimal growth in the dividend, but it's because we're adding growth to the portfolio itself.
Now, speaking of that growth, how big is the market out there for your streams? Because you pretty much pioneered streams 20 years ago. You just had a 20th birthday, haven't you?
Yeah.
In that sense.
So, yeah.
So it's, I guess, it's a business model which has caught on in some areas. There are a couple of other companies out there. How much of the market is still left open to you, in your opinion?
Well, we've still been able to dominate the space in the precious metal streaming, but the traditional royalty companies have all become streaming companies. The Franco-Nevadas and the Royal Golds are the 2 major ones, And we've also had a lot of copycats, a lot of new companies start up. They just haven't been able to get the serious sort of foothold in there. So it's going to be tough for them. A lot of them have had to give up structural weaknesses to try and get their foot in the door, and their streams just aren't as good as some of our good old Wheaton streams. But we've concluded over the last 4 years, we've concluded over 60% of all the different precious metal streaming opportunities. So we are still dominating the space and growing it. How big? How much capital does the mining industry need? it's
we can safely say more than it's got.
Exactly, right? That's the thing, is that the challenge, the biggest challenge that I have is that we do really focus on the best half of the assets, the lower half of the cost curve out there. And probably the biggest challenge we run into is if those assets are already operating, they're generating enough internal cash flows. They don't really need our outside cash flow. And so it makes it challenging to stay on that. We do see a lot of lesser quality assets that we're much happy to pass on and let our peers acquire. And the biggest hurdle is maintaining access to high quality assets. But the other approach that you have to have in this industry is to make sure that you recognize that sometimes it's better not to make the transaction. And the commodities that we're investing into are cyclical, and you don't want to be investing into these things at the top part of the cycle. You have to make sure that you're set so that you can harvest for a while if it comes down to it. So, we went back in 2010 to 2013. We didn't do any transactions. That was because prices were so boisterous and so rich. Not really the time to be buying. But I tell you, it set us up beautifully for 2014, 15, 16, all the way really through till 2018, where we had to go and help fix balance sheets for a lot of the biggest companies in the world, Glencore, Vale. It's something that we need to be cognizant of. This is not a business where you're always buying. We are not deal junkies. There is a time to sort of sit back and harvest from the portfolio that we have, and especially with the growth portfolio that we have going forward. If we start feeling that the markets are frothy and perhaps things are overpriced, we'll sit back and sort of build up that balance sheet, grow the dividend, and prepare for the inevitable other side of the mountain.
Speaking the other side of the mountain, and we may not be anywhere near there yet, I don't mean to imply that, but it would be remiss if we didn't talk about the gold price, about precious metals prices.
Yeah.
Not long ago, we had Mr. Trump coming in, and then suddenly the gold price dropped $100, and then it picked up $100, and then it went down $70. How do you see this little bit of volatility, and what do you think the future holds?
Well, I think more of the same. I mean, the challenge that we have with such a decisive election in the United States, that was a very strong victory, and Trump controls all the houses and the Supreme Court. And so, we're going to get whimsical comments like absolutely 25% tariffs on Canada and Mexico. Bang! All of a sudden, U.S. dollar gets fake strength. It's not real strength, because any tariffs the cost of those tariffs ultimately feeds down to the consumers themselves. So that's just going to drive inflationary pressures within the United States. And that is an environment that gold works well in. I would also argue that it drives weakness in the U.S. dollar, and yet, there's an artificial strength in the U.S. dollar every time he comes out with one of these comments, but it's not sustainable. It's an emotional response to, wow, the U.S. dollar is going to be stronger. And then when people start thinking about it, you see it rebounding back to as we expect. And so I do expect a lot more volatility during Trump's tenure as the 47th president of the United States. But I'm happy with the way gold responded to that. I do think there was a bit of a risk off, because there hasn't been strength in the U.S. presidency for a long time. It's always been a divided house and such. And so I do think that what we're going to see over the next while, ultimately, the fundamentals still don't support. They don't support the U.S. dollar. There's just so much momentum around the world, and I would argue that this recent push in gold prices was one of the first ones that didn't come from the West. It actually started in the East and the Southeast and the Middle East, where we started seeing sovereign central banks swapping out U.S. dollar reserves for gold. And that is just spreading. We're now seeing it a lot more in Eastern Europe. And we're seeing this entire BRICS organization, of which I would highlight the only thing that aligns that very diverse group of countries is a mistrust of the U.S. dollar. So gold is going to continue to grow in importance in terms of that. I think it's not far off before we'll wind up having reverting back to what the U.S. dollar used to be, which was a gold-backed currency. Up until 1971, it was a gold-backed currency, and it's one of the reasons why it had such gained such an incredible foothold as a main reserve currency in the world. So, gold is returning.
So I once did a calculation for the US to be fully backed by gold. I reckon gold has to be about $10,000 an ounce. Are you with me on that?
Or I will say that we did, I'm a very active member and a past chair of the World Gold Council, and we are pushing our way towards digitalizing gold and making it easy to trade, making it so that it's an instant and atomic settlement, instant traded at very low costs, which will make it look a lot like a currency. And if we can get to that stage, we can get to the technology is there. It will happen. It's only a matter of time. But I will say that coincidentally, we did a SWOT analysis.
Yeah.
And the $10,000 an ounce number came up in our SWOT analysis in terms of a risk of excessive demand. And one of the concerns we had is if we race there so fast, that volatility will sort of concern people about the stability of gold, right? I'm willing to suffer from that. As the CEO of Wheaton, I'm willing to suffer through that instability of $10,000 gold. So we'll be doing very well. Us and our shareholders will be doing very well on something like that.
I won't say you heard it here first, but you did hear it here. Randy, since I got you, and we got a little bit of time, silver, because you said that was a 33%.
Yeah.
Will it follow gold, or it's dancing to it?
It always does. And I will say my favorite metal is silver. I really do think that there's some good fundamentals behind it, stronger fundamentals than what you see in gold. The one weakness in silver is that it's such a small market. And it's why after 10 years of our company, we swapped from being Silver Wheaton to Wheaton Precious Metals and now more focused on gold. It's just there's not much opportunities in the silver space. That is actually one of the highlights of silver is that there's not a lot of new silver production coming on. We saw peak silver production about 6-7 years ago. We see increasing demand. I think we're 2/3 of silver is now used in high efficiency electronics and antibacterial applications, solar panels, anything like that. We just see that. When the investors wake up in silver, silver always outperforms gold. Now, I warn everyone that it goes in both directions. It does. Silver has much higher beta. And so, you just have to make sure you're in the right position. But right now, what we're looking at is strength in the gold market, and silver has really underperformed. It has never gone forever. It usually will wake up and find its way. And so I do think that silver will have its day.
PGMs, because you've got a big stream with Ivanhoe's Platreef project,
right,
coming into production next year.
An incredible asset. It's going to reset the platinum and palladium market in terms of costs and safety, especially the South African PGM market. It's a bulk mineable underground operation where it'll be much safer mechanized mining versus sending staff into shrinkage stopes. So, yeah, exactly. The small little reefs that dipping at 20 to 30 degrees, some of the most expensive and dangerous mining in the world. And I think the quantity, especially with Platreef or with Ivanhoe's announcement of pushing it up to 10 million tons per annum, within months of us closing the deal, all of a sudden they've announced they're going to double the capacity. It's going to reset the entire market. So I'm glad that we're invested into this. We are, the bulk of our value on that stream is actually gold. We get about 65% of whatever gold, I think 63% of whatever gold comes from the mine, which is actually a little healthy byproduct. And then we get 5% of the platinum and 5% of the palladium. And so we're excited about the project. We do think it is going to reset the entire platinum and palladium market with a very low-cost producer. It'll be the low quartile of the entire PGM market. And so having that as an asset in our portfolio, we're very excited about where that's going to go.
So, Randy, just to recap, for the investors out there who are thinking, I like the space, do I buy the metal, do I buy a miner, or do I buy Wheaton Precious Metals, the streamer, just recap on the advantages of the streaming business model.
Well, you've got a risk spectrum, right? At this end, you've got the metal. You can buy the bullion or buy ETFs. There's fees to it. The problem with this is that there's no growth on the end of the low risk end of the spectrum. The high risk end of the spectrum is the mining companies. The challenge with that is that when you see stronger prices, costs will always chase the price. They never ever can maintain margins because lower grade material becomes economic and it has to be processed. And so in the middle, and I would say taking the best of this, but leaving the worst behind, which is costs, operating costs, capital costs. You know what our costs are. They're fixed by contract. They're defined. They're predictable. And I can assure you we will never pay more than $500 per ounce of gold, because all of our contracts stipulate that we're around $440, $450 per ounce of gold. So we've got that confidence, and yet we still get, because we get a percentage of whatever the mines produce, we get the exploration upside, we get the expansion potential, and because of that production payment, we actually have leverage exposure to the commodity price. Oh, yeah, and we pay a dividend. You don't get a dividend over here. So we actually pay you to own our shares versus owning bullion. I really think that streaming is the best way for someone to dip their toe into the precious metal space, and I really strongly encourage everyone in today's world, you need to have at least a part of your portfolio in the precious metal space. And Wheaton is, I think, a fantastic way to dip your toe in and get in there. And as you gain confidence, you can take on some of the higher risk opportunities. But I caution you that you should always have a good, sound, stable portion of that investment into a company like Wheaton.
All right, Randy, thank you very much indeed. Ladies and gentlemen, that was Randy Smallwood, the President and CEO of Wheaton Precious Metals. You've been watching Edison TV. We'll be back with more opportunities, thoughts and investment ideas in the very near future. Until then, though, you have a capital day.